Peace, 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 family. Your boy Treetop Chris checking in. Today we're going to talk about something called Plocs and Helocs. What's a Ploc and a Heloc? A Ploc is a personal line of credit. A Heloc is a home equity line of credit. What's the difference between the two? Well, let's break it down. A Ploc is a personal line of credit. Personal line of credit from the bank. You would go to the bank and you get a credit card normally. That's also a personal line of credit. But it's not exactly a personal line of credit because this is a different product. What this is basically a loan that you create on tap. Whenever you want to create the loan, you just go in, transfer the money from your personal line of credit to your checking account, same as cash, same day, takes 5 minutes, and instantly you'll have a loan that you can pay back at an interest rate that uses simple interest. With the Ploc, you can get a car, you can get anything you want to buy normally that you would use a credit card to get, but the interest rate are usually very cheap in relation to a credit card. Some of these credit cards is going to be 18 to 29%. Personal line of credit, you get an interest rate around 7 to 16%. Say you get a loan of $10,000, a personal line of credit of $10,000 at 7%. Right? 7%. That means on the $10,000, when you take that from the bank, you're only going to owe $700 back to the bank. $700, right? Now, this is all you owe. So you see the power in a personal line of credit versus a credit card? Now, you have to understand something about the Ploc. The Ploc, with it being a personal line of credit, the Ploc is unsecured. That means that the bank has no way of getting their funds back if you decide not to pay them. That's why the interest rates are usually high on a Ploc than they are on a Heloc, because the Heloc is secured by your home. You got to keep that in mind. The Ploc is always going to be higher than the home equity line of credit. But remember, the credit cards don't work the same as a Ploc. With the Ploc, you can go in and make a transfer whenever you need it, right? When you have a credit card, if you want to take money out of the credit card, it's called a cash advance. And what happens when you get a cash advance? They always charge you more, right? Because you're taking the cash out of the credit card. Now, we teach people how to liquidate credit cards in multiple different ways, but you don't have to do that if you have a Ploc, because you can just go into your bank account and transfer the money right over when you need it. Plocs are very easy to use because they're easily liquidated. We're going to use some good terms in here, people. We're not just going to be talking about turning credit to cash. We're going to be liquidating our credit into physical assets that we can use for later. Now, if you want to go into business or anything like that, the Ploc is great for that, because whenever you need the cash, you can just go and grab it. It'll be a loan that you can pay back, and then right after that, you can keep using it over and over again, usually for about 12 years. Ploc is great for that. Now, what is the Heloc? This is a home equity line of credit. Home equity line of credit. Now, with the home equity line of credit, it's secured by your home, so the interest rates are going to be a lot cheaper. 4 to 12% interest on average, a lot better than the Ploc. Remember, the Ploc is unsecured, but with the home equity line of credit, they have your house as a security. So if you don't pay it back, they're not just going to sue you or close your account. They're going to take your house from you. So of course the interest rate is going to be a lot cheaper, but you got to keep this in mind. It's still a powerful way to pay your mortgage. What? So you can use your own house, take out a home equity line of credit, use the funds from your home equity line of credit to pay your mortgage down faster. Why is that a good thing to do? The interest rate on a regular mortgage are always 150 times what you think they are. Check this video out right here where I do the quick calculation on how you can figure out how much you're paying on your home loan, astronomical, versus what you see on your actual mortgage. Because a lot of people think if they get a $250,000 home, they're going to pay back a little bit more than $250,000, and they don't think that they're going to end up paying $500,000, in which case that's usually the case. The E in home equity line of credit is the most important thing in this whole entire process. What is equity? A lot of you have homes, and the people who don't have homes, you're thinking about getting your own home. Some of you are going to rent forever. That's totally fine. Nothing against that. But if you rent, you'll never have the ability to create the Heloc, and that's your home bank. And how is it your home bank? Because every month you make payments on your mortgage, right? Over time, your house becomes worth some money. Everybody knows that the house is worth some money. Really, what it's called is called equity. This word right here. You are creating wealth by paying down the mortgage, and as the mortgage goes down, the value of the home goes up. And the difference between the mortgage and the property value is called equity. And what you can do with that equity is you can turn that equity into a home equity line of credit. Take the money that you have that your house is worth, you go to the bank, and the bank will create a second mortgage on your home worth the equity in your home. Now, what does that do to your mortgage cost? It doesn't make your mortgage cost go up. It creates a different loan that has a different loan amount. So if you're paying $1,600 a month for your mortgage, then your home equity line of credit will be whatever you decide to spend on that home equity line of credit. So say, for instance, say you had a $250,000 home, and then over a couple years you pay paid off 50 grand of it. If you pay $50,000 in your home, that means you owe 200,000. This will be your equity, that 50,000. So what the bank will end up doing is they'll give you a set amount of your equity. So normally it's around 60 to 80% depending on your credit score, depending on your finances. You go to the bank and say, bank, can I get a home equity line of credit? They'll say, okay, sure. You have $50,000 paid off in your mortgage. We're going to give you 70% of your equity. So how do you calculate that? Real simple, $35,000. So that $50,000 that you have in equity, they'll give you 70% of that. So you'll now have a line of credit of $35,000 that you can use for anything. You can go buy a car, you can start a business, you can use that money to put a down payment on another property and start the whole process over. You see how it becomes a bank in a sense? Because what you can do is every time you pay your mortgage down over time, you can actually go to the bank every 6 months and ask them for an increase in the Heloc if you like. And you could just keep doing this over and over again. But how long does the Heloc last? They usually give you about 12 years to use the loan over and over and over again. What do I mean by over and over again? Use the entire $35,000 and you pay it back. It's not like a personal loan. When you pay back the $35,000, it refills. 12 years to reuse the funds on a home equity line of credit or a personal line of credit. So that means you can pay $35,000 to anything you want, pay it back to the bank, get the $35,000 back. And you can do this without asking the bank. Every single time you take the money out, it's just a transfer to your checking account. You don't have to go back to the bank and ask them for anything. This is your money to loan to yourself. So this is how you create the home bank that you use. Remember, you're still making mortgage payments. So if you're making mortgage payments on top of paying the money back on a home equity line of credit, what happens to your equity? Your equity increases. So before you know it, you might have $100,000 in equity, but you only have a $35,000 home equity line of credit. So what do? You go back to the bank and you say, hey, you asked them for an increase in your home equity line of credit. Remember, they're going to give you 70%. What's 70% of 100,000? That's 70 grand. $70,000 to do whatever you want with. Anything you could think of with that 70 grand, because you got 100 grand in equity in your house. Your house was 250,000. You paid off 100,000 of it. You got a mortgage or a loan balance on your mortgage of 150 grand. So that $100,000, the bank is going to give you 70%. That's $70,000 that you can use over and over again. How do you get slick with it, right? You use the equity from your own home to pay the mortgage back. Remember, you use home equity line of credit to pay your mortgage off faster than you would have if you just made the normal payments plus extra payments. Remember, you have $150,000 left on your mortgage. So what do you do with the 70,000 now that you got 70 grand? Because remember, you had 35,000, right? That 35,000, you were responsible. You paid it back on time. You've been paying your mortgage. You did whatever you need to do. How do you pay off your mortgage faster and get an even bigger home equity line of credit? You take 60% of your home equity line of credit and you dump it directly on the mortgage. What's 60% of 70,000? That's $42,000. Now you take 60% of your home equity line of credit, 60% of your home equity line of credit, and you're going to put this directly on your mortgage. And what is that going to do? It's going to kill the interest before it even accrues. Before they even get those months of interest, you're going to pay with your home equity to kill the months later on down the line. So if you have a 30-year mortgage and you have maybe 2 or 3 or 4 years left, or say you have 8 to 9 years left on your mortgage, right? You can drop this $42,000 on that mortgage and knock off a couple years of payments. Now you took the equity out your home, you still have some left, and you made a $42,000 payment on your mortgage. Now your mortgage balance is $108,000. So what do? You keep paying your mortgage, right? But now your mortgage is a lot smaller because it's only $108,000. You put the $42,000 on there, you make the home equity line of credit payments as you normally would, you make your mortgage payments as you normally would. What does that do? It knocks off years of your mortgage, because remember, that $42,000 that you just made that payment on, you wouldn't have made a $42,000 payment in 1 year. But because you're using the home equity line of credit, you're using your home bank, you can take the interest away from the bank, put it into a smaller amount. Because if you remember the video, the interest rate is astronomical. The actual interest rate is tremendously high. So you have to keep in mind that you're moving it over to simple interest, 4 to 12% simple interest. Simple interest is different than amortized interest. It's different than how they calculate a normal mortgage payment rate, because remember, simple interest is where you want to be. How does simple interest work? With simple interest, if you have $1,000 at 4%, you only owe $40 on $1,000 instead of how we calculated it before. Simple interest is totally different than how they calculate the interest on a home. Now imagine if you owed that $42,000 that we talked about. $42,000. If you borrow $42,000 at 4% simple interest, you're only paying $1,680. There's no way you're going to pay $1,680 on $42,000 on a mortgage, because if you remember remember, the calculator is always bigger than what it seems, right? I would rather pay $1,680 than all of that money they're trying to get me to pay on that mortgage, right? So what we need to do is we need to transfer as much debt as we can from actual mortgage over to simple interest. Simple interest is key. This is why the Ploc and the Heloc is so powerful, because if you use the Ploc and Heloc, you can turn that death note, what we call a mortgage note or mortgage, into simple interest. That's the whole process in this. Now, if you need help with this, I help all my clients understand how this works, and I help you get an actual Heloc or Ploc. So if you have trouble getting it from the bank, I can make sure that your chances of getting a Ploc or Heloc are 70 to 100% higher than it would be if you didn't have a financial advisor / money agent to do it for you. Your boy Treetop Chris checking in. Peace and love.